Today, we're going to take a look at our final chapter, which is chapter 16. And chapter 16 is dealing with financial statement analysis, and that helps managers to use and to assess the financial health of their companies. It includes examining trends in key financial data, comparing financial data across companies, and analyzing financial ratios. Again, chapter 16, which is dealing with financial statement analysis. Okay, so some limitations on financial statement analysis, comparing financial data across companies. Differences in accounting methods between companies sometimes makes it difficult to compare their financial data. And again, examples are if one company values its inventory using the LIFO or the last in, first out method, and another company uses the average cost method, then direct comparisons of financial data, such as inventory valuations and cost of goods sold, may be misleading. Even with this limitation in mind, comparing financial ratios with other companies and industry averages can provide useful insights. So looking beyond ratios. Ratios should not be viewed as an end, but rather as a starting point. They raise many questions and point to opportunities for further analysis, but they rarely answer questions by themselves. In addition to ratios, other sources of data should be considered, such as technological changes, industry trends, changes within the company itself, changes in customer tastes, and changes in broad economic factors. And again, there are limitations to relying on financial statements by identifying events that could make financial statements doubtful as a predictor of the future. So even, looking at a financial statement, it may not be an accurate predictor of the future. Example might be a change in the oil prices that occurs after the financial statements are issued. An increase in oil prices would be favorable for companies with large stocks of petroleum and unfavorable to companies that use large quantities of petroleum feedstocks in their manufacturing process. Obviously, if a company had a lot of petroleum and they weren't using it very quickly, then if there's a temporary spike in oil prices, it wouldn't affect them. But obviously, a company that uses a lot of that and the price spikes and they don't already have it, then that would have an impact. So again, just realizing you look at the financial statements and the ratios, but you also have to look at things outside of that in order to compare and make judgments. Okay, so our first learning objective is to prepare and interpret financial statements in comparative and common size format. And so first, some key concepts. An item on the balance sheet or income statement has little meaning by itself. The meaning of a number can be enhanced by drawing comparisons. And in this chapter, we're going to discuss 3 different types of comparisons. Dollar and percentage changes on statements, which is horizontal analysis, common size statements, which is vertical analysis, and ratios. Now, dollar and percentage changes on statements. Horizontal analysis, also known as trend analysis, involves analyzing financial data over time. Quantifying dollar changes over time serves to highlight the changes that are often the most important economically. Quantifying percentage changes over time serves to highlight the changes that are the most unusual. And we'll get an example of this horizontal analysis in looking at the company called Clover Corporation. And so the following slides will illustrate a horizontal analysis of Clover Corporation balance sheets and of their comparative income statement for this year and last year. So we're going to assume the comparative asset account balances for the balance sheet are shown here. So we see here for the assets, we have last year and we have this year. And we're going to look at the amount of change and the percent. Anything that's in parenthesis would be considered a decrease. And so how to calculate that. So the first thing we're going to do is calculate for dollar change. The dollar change in account balances is calculated as we see here on the screen. Notice that last year serves as the base year. So it would be whatever the current year minus the base year. And the dollar amounts of last year would become the base year. And then to calculate the percentage of change in account balances is calculated as shown. So it is the dollar change over the base year figure. So the current year dollar change over the base year figure, and that gives us times 100% to convert it to a percentage. And so we see here how they would do that. So the dollar change for cash of minus 11,500. So it actually decreased 11,500. And then also the percentage change of 48.9% decrease. We see how they calculated that. So they took 12,000 minus 23,005, gave us negative 11,500, and we took 11,500 divided by the 23,500, which was last year, which is the base year, divided by 100, multiplied by 100% gives us the percentage. And so the dollar and percent change for all of the remaining assets are shown here. Now, we could do this for liabilities and stockholders' equity, but instead, let's look at the income statement. So you could do the same thing if you wanted, but we'll go ahead and look at it as it applies to the income statement. So we're going to assume that Clover has the comparative income statement that is shown here. And so we see their sales from this year, we see the sales and everything from last year. And you would calculate the amount and the percentage the same way that we did previously with the balance sheet. But notice that their sales increased by 8.3%. So from this year to last year, it increased, but yet their net income decreased by 21.9%. There was an increase in cost of goods sold of 14.3%, and the operating expenses 2.1% that offset the increase of sales. So we see that even though they did have an increase of sales, they also likewise had an increase in their expenses. Okay, so we see that here. All right. Horizontal analysis can be even more useful when data from a number of years are used in order to compute trend percentages. And so again, to do that is the current year over the base year amount times 100%. And so the base year is selected, and then all data for all years are stated in terms of a percentage to that base year. So we'll look at that in terms of Berry products. So we're going to assume the financial results are shown for years 1 through 5. Notice that the base year is going to be year 1, and its amounts would equal 100%. Okay. So we see that. The year 2 results restated in trend percentages would be computed as shown. So we're going to take what the year 2 divided by the year 1 amount times 100%. And we can do that for each area, for their sales, their cost of goods sold, and their margin. And then we can do the same thing then for the remaining years. Notice that the cost of goods sold is increasing faster than their sales. So that tells us, and again, we need to make adjustments to that. Now, the trend percentages can also be used to construct a graph, so such as this. So we can do that for sales, our cost of goods sold, and our gross margin. It allows us to generate a chart, and then we're able to look at it and analyze it further. All right, common size statements. So vertical analysis focuses on relations between financial statement items at a given point in time. A common size financial statement is a vertical analysis in which each financial statement item is expressed as a percentage. And in balance sheets, all items are usually expressed as a percentage of total assets. And then for our income statement, all items would be usually expressed as a percentage of sales. And so again, we'll take a look for Clover Corporation, and this time using common size statements. Now notice that as previously mentioned, sales are usually the base and are expressed as 100%. So then you have you'll do that. So you see that sales are 100%, and then we take then everything as a percentage of that for the income statement. So the operating costs or selling administrative expenses as a percentage of sales for last year, 26.2, and this year, 24.8, are computed as shown. So we take the last year, for example, this year's operating expenses divided by this year's sales times 100 gives us the percentage. And then we can do the same thing for last year's operating expenses over last year's sales times 100 gives us the percentage. Now, the common size percentages for the remaining items on the income statement are shown. So we can do that. And again, it's a percentage of sales. All right. So quick check, horizontal versus vertical analysis. So which of the following statements describes horizontal analysis? And it should be B, that horizontal analysis is a side-by-side comparison of two or more years' financial statements because it shows the changes between years and the financial data in both dollar and percentage form. And then we'll take another look, this time calculating ratios for Norton Corporation. So we are going to examine ratios that managers use to better understand organizational performance. To facilitate our discussion, we are going to use financial data for this year and last year from Norton Corporation. The asset sides of Norton's balance sheets are shown here. So this is all of our assets for Norton Corporation. And then this is showing our liabilities and stockholders' equity for Norton. And then our income statements for Norton. Again, this year and last year for Norton. And again, looking at ratios, we're going to go into each ratio, and then we're going to see here if it would be if an increase in that ratio would be good news or bad news, and why. And then remember that these ratios cannot be analyzed in a vacuum. Comparisons with industry averages and prior years are essential. So you can't just look at this. You're going to have to look at what the trend is and what industry and what happened in the previous year. So we're going to compute and interpret financial ratios that managers would use to assess liquidity. And the data and ratios that managers use to assess liquidity include working capital, the current ratio, and the asset test or the quick ratio. The information shown for Norton Corporation will be used to calculate the aforementioned liquidity ratio. So we'll use this to calculate. So we need to know cash, the accounts receivable total, net, and then total assets and liabilities. Those are the numbers that we'll need in order to figure out for liquidity. So our first ratio that we're going to take a look at is dealing with working capital. So the excess of current assets over current liabilities is known as working capital. Working capital is not free. It must be financed with long-term debt and equity. Therefore, managers often seek to minimize working capital. A large and growing working capital balance may not be a good sign. For example, it could be the result of unwarranted growth in inventories. And so we take the current assets and the current liabilities, and if we subtract the two, we get what our working capital is. And so in this case, Norton Corporation has working capital of $23,000. So again, this is one we have to watch carefully because we want to make sure, again, looking at that, the assets and what it is relative to debt. Because again, this comes through the form of long-term debt and equity. So looking at that. Now, the current ratio is computed as shown, and the current ratio is the current assets divided by the current liabilities. It measures the company's short-term debt paying ability, and it must be interpreted with care. For example, the declining ratio may be a sign of a deteriorating financial condition, but it might also result from eliminating obsolete inventories or other significant or other stagnant current assets. So again, finding out exactly why it is low and questioning that if it is declining. So in our example, Norton's current ratio is 1.55. And so we have current assets over the current liabilities 1.55. What that means is that they can pay 1.55 times over their debt. So the higher that number, generally, the better off that they're doing. But again, you got to find out, make sure you understand the totality. Okay, the asset test or the quick ratio. The asset test ratio is computed as shown, and so it is defined as quick assets over current liabilities. So it's similar to the current ratio, but not exactly the same. Quick assets so it is a more rigorous measure of short-term debt paying ability because it only includes only certain current assets that we could quickly turn into cash. And so that would be items such as cash, marketable securities, accounts receivable, and the current notes receivable ratio. This ratio measures the company's ability to meet obligations without having to liquidate inventory. And we see here that for Norton Corporation, their asset test or quick ratio of 1.19 is computed. What that means is that for each dollar of liabilities, well, as a general rule, each dollar of liabilities should be backed by at least a dollar of quick assets. And in this case, they do meet that condition. All right. So learning objective 3, which is ratio analysis and dealing with asset management. So we'll look at that. Okay, managers compute a variety of ratios for asset management purposes. The information shown for Norton Corporation will be used to compute the asset management ratios. And so we see here just a snapshot of the different assets, and then we see some information from the balance sheet, and we see some information from their income statement. It says you may also use information that was provided in an earlier slide in order to get these calculations as well. Okay, so the first one that we would use is the accounts receivable turnover. And that is calculated as the sales on account divided by the average accounts receivable. And in order to calculate that, we would take, so we find out what the sales on account were total, and then we're going to take the beginning amount of accounts receivable, add the ending amount, and then divide by 2 to get your average. And so what this ratio measures is how quickly credit sales are converted to cash. And we see that Norton Corporation receivables turn over 26.7 times throughout the year. So that's really good. So again, generally speaking, the higher this number, the more times it turns over, the better that you are. Now, a related measure is called the average collection period, and that is calculated as shown. So it's 365 days over the accounts receivable turnover, which we calculated previously. And so 360 days divided by 26.7 is 13.67 days. What this ratio calculates is how many days on average it takes to collect on an accounts receivable. It should be interpreted relative to the credit terms offered to customers. So you'd like to find out, okay, what credit terms do you give customers? Do you know in terms of the discount period or in terms of how long you give them to pay? And so Norton's average collection period is 13.67 days. And so generally speaking with this, the fewer days, the better off you are because that's how fast you're getting paid faster for your accounts receivable. So you generally want it to be a lower number for the average collection period. Now, another one might be our inventory turnover. The inventory turnover is computed as shown. So it's the cost of goods sold over the average inventory. So again, the beginning inventory, the ending inventory added together, divided by 2 gives you the average inventory. What this ratio does is it measures how many times the company's inventory has been sold and then replaced during the year. And it should increase for companies that adopt just-in-time methods. So if you're using just-in-time inventory, this number should be relatively high. It should be, okay, I'll mention that. But if a company's inventory turnover is less than its industry average, it either has excessive inventory or the wrong types of inventory. So you have to look at that. So if it's taking a long time, inventory is not really turning over faster. They either have too much inventory or the wrong type of inventory. And you also want to look at this based upon the company's industry. So for example, grocery stores would have to turn their inventory over quickly, right? Because grocery stores, most of the things in a grocery store are things that would spoil quickly, right? So meat, eggs, bread, fresh produce, any of those kinds of things are things that spoil fairly fast. So a grocery store this would be a huge number, how fast it turns over. But for example, a grocery store, they're going to tend to turn their inventory over more slower, right? So a jewelry store, they might turn their inventory over a lot slower. Maybe a furniture store, they might, turn their inventory over a little bit slower, possibly. So if a company's inventory turnover is less than its industry average, as we said, it either has excessive inventory or the wrong types of inventory. So in this example here, we see that for Norton Corporation, inventory turnover of 12.73 times is computed. And so it means that it turns over 12 times a year. So at least looking at this, you could say at least once a month, the inventory turns over on average. And so that's pretty good. Again, depending on what type of company this is that we're looking at. So now a related measure is the average sale period. And it measures the number of days being taken on average to sell the entire inventory one time. And so that's 365 days divided by the inventory turnover that we calculated previously. And we figure that it takes them 28.67 days. And so this measure shows how many days on average it takes to sell through the entire inventory. And again, this can be, again, that number you want it obviously probably to be a lower number. Obviously, if it's taking too long, then you run the risk, depending on what you're doing, either of the product spoiling, becoming out of date, and so on and so forth. So you want to look at that um, again, but how's that going to affect? Um, you don't want to worry about memorizing the formula, but really understanding what the formula is about and what it's doing. Okay, so now we'll take a look at operating cycle. The operating cycle is calculated as shown. So it's the average sale period plus the average collection period is our operating cycle. And what this measures is the elapsed time from when inventory is received from suppliers to when cash is received from customers. And we see here that for us, we already worked these out. So 28.67 days plus 13.67 days. So the inventory turnover and then the days in collection is 42.34 days. And again, you'd like this number again to be lower. Because again, it has to do with, how quickly you're receiving your money back. Okay, so total asset turnover. Total asset turnover is defined as the sales over the average total assets. And again, what this ratio does is it measures how efficiently a company's assets are being used in order to generate sales. This ratio expands beyond current assets at all because it also includes all of your non-current assets as well. And so in this case, we had that. So we had our total sales, which is 494,000. We divide that by our average total assets, which started out at 300,000, ended at 346,390. We're going to add both of those up, divide them by 2, divide it. We come out that it's 1.53 times. And so again, looking at this, you want this to be a little bit higher. All right, learning objective 4 is dealing with debt management. So we're computing and interpreting financial ratios that managers would use for debt management purposes. So managers compute a variety of ratios for debt management purposes. The information shown for Norton Corporation will be used to calculate its debt management ratios. So the times interest, so this one's times interest earned ratio is calculated as shown. So it's the earnings before interest expense and income taxes over the interest in expense. And so in this example, it's 84,000 divided by 73,000, which is 11.5 times. This is the most common measure of the company's ability to protect its long-term creditors. And it's based on earnings before interest and income taxes because that is the amount of earnings that are available for making interest payments. Just note here that a ratio anything less than 1 is inadequate. So anything above 1 is what we look for. And in this case, for Norton Corporation, it was 11.5. So they're doing very well with that. Now, debt to equity ratio, and that is total liabilities over stockholders' equity. And what this does is it indicates the relative proportion of debt to equity on the company's balance sheet. Stockholders like a lot of debt if the company's rate of return on its assets exceeds the rate of return that's paid to creditors. Creditors prefer less debt and more equity because equity represents a buffer of protection. And so in this case, it's computed as 0.48. And then the equity multiplier. The equity multiplier is computed as the average total assets over the average stockholders' equity. And what that does is it indicates the portion of the company's assets that are funded by equity. It focuses on average amounts maintained throughout the year rather than the amounts at any one point in time. So it's the average amounts maintained throughout the year. And we see here how it's calculated. So for Norton, their equity multiplier is 1.56. So learning objective 5, which is computing and interpreting financial ratios that managers use in order to assess profitability. And again, we'll use this information in order to calculate their profitability ratios. So the first thing is the gross margin percentage. Gross margin percentage is the gross margin divided by sales. And what this does is it measures how much of each sale dollar is left after deducting the cost of goods sold to cover expenses and provide profit. And this number should be more stable for retailing companies than for other companies because the cost of goods sold in retailing companies excludes fixed costs. And so in this case, for Norton Corporation, the gross margin percentage for this year is 71.6%. So that's really good. Okay, net profit margin percentage. Net profit margin is calculated as net income over sales. And what that means is in addition to the cost of goods sold, it also looks at how selling and administrative expenses, interest expense, and income tax expense would influence performance. And in our example, because net income over sales, our percentage is 10.9. And so again, that's, you got to look at that in perspective to the sector that the business is operating in. Now, return on total assets. The return on total assets is computed as net income and then plus. So you'd have to work this other part here out first, but it would be the interest expense times 1 minus the tax rate. So you'd solve for 1 minus the tax rate first, then you'd multiply that by the interest expense, and then you'd add your net income over the average total assets. And so adding interest expense back to net income enables the return on assets to be compared for companies with different amounts of debt or over time for a single company that has changed its mix of debt and equity. And so for Norton Company, the return on assets for this year is 18.19%. Then we have return on equity, which is the net income over the average stockholders' equity. And what this shows is it indicates how well the company used the owner's investment to earn net income. And so for Norton Corporation, the return on equity for this year is 25.91%. Now, another way that you can do this also to figure out the same thing is called the DuPont formula. So you can also use this DuPont formula in order to calculate the return on equity. And so to figure that out, you're going to take the net profit margin multiplied by the total asset turnover multiplied by the equity multiplier. So again, you have all of these. You can multiply them all together and you'll get the DuPont formula to figure out the return on equity. Now, the return on equity can also be computed using this. Okay, financial leverage. Financial leverage results from the difference between the rate of return the company earns on investments in its own assets and the rate of return that the company must pay to its creditors. So positive financial leverage exists if the rate of return on a company's assets exceeds the rate of return the company pays its creditors. In this case, having some debt in a company's capital structure can benefit shareholders. Now, negative financial leverage exists if the rate of return on the company's assets is less than the rate of return the company pays its creditors. In this case, the common stockholder suffers by having debt in the capital structure. So again, a positive financial leverage is where the company's asset exceeds the rate of return, and a negative financial leverage is where the rate of return of the company's assets is less than the rate of return that they pay creditors. So quick check. Which of the following statements are true? And it is A, that negative financial leverage is when the fixed return to a company's creditors and preferred stockholders is greater than the return on total assets. All right, learning objective 6 is to compute and interpret financial ratios that managers would use in order to assess market performance. And then we'll use the following information in order to calculate market performance ratios. And the first one we're going to take a look at is earnings per share, otherwise known as EPS. So the earnings per share is computed as net income over the average number of common shares that are outstanding. And this is the average number of common shares outstanding. We can compute that by adding the shares outstanding at the beginning of the year to the shares that were outstanding at the end of the year and then dividing by 2. Managers analyze this ratio because earnings form the basis for dividend payments and future increases in the value of shares of stock. And so whenever a ratio divides an income statement balance by a balance sheet balance, the average for the year is used as the denominator. And earnings, as we said, so this is looking at how they do their dividend payments. So to kind of know how much their earnings are per each share. And so for Norton Company, the earnings per share for the year was $2.42. So this shows how well they're doing. Now, price earnings ratio. The price earnings ratio is computed as shown. So it is the market price per share over the earnings per share. And what this is a higher price earnings ratio means that investors are willing to pay a premium for the company's stock because they have an optimistic future growth potential. And so in this case, Norton Corporation's price earnings ratio for this year is 8.26 times. So that's really good. Now, dividend payout ratio. And that is computed as the dividends per share over the earnings per share. And investors who seek market price growth would like this ratio to be small, whereas investors who seek dividends prefer that it be large. So you want it to be less if you want the company to use their earnings in order to further the company and to do that. You want this number to be larger if you're an investor that's interested more in dividends. And so for Norton Corporation, their dividend payout for the year is 82.6. And so this company, they pay out quite a lot in dividends. So the next part of that is the dividend yield ratio. And what this is the ratio is computed. It is the dividends per share over the market price per share. And that is calculated thusly. This ratio measures the investor's rate of return in the form of cash dividend only when buying common stock at the current market price. And so in this case, Norton Corporation's dividend yield ratio for the year is 10%. A book value per share. And what this shows is calculated as the common stockholders' equity over the number of common shares that are outstanding. And so in this case, it would be $8.55, the book value per share. And so what this is measuring the amount that it would be distributed to holders of each share of common stock if all assets were to be sold on our balance sheet, carrying amounts after all of the creditors were paid. And so that paid off. And so this measure is based on historical cost. Norton Corporation's book value per share at the end of this year is $8.55. Now, notice that the book value per share of $8.55 doesn't equal the market value per share of $20. This is because the market price reflects expectations about future earnings and dividends, whereas the book value per share is based on the historical cost. Okay. And in this slide contains a listing of published sources that provide comparative ratio data organized by industry. So you want to look at this, know that you want to compare this to your industry. So again, depending upon what you're doing, you can use some of these different sources in order to figure that out. And some of these you might have to pay for. Some of these, for example, Edgar, which is through the Securities and Exchange Commission, you don't have to pay for because that's a governmental database. D&B Hoover's online, you may not, and in Hoover's, you may have to pay them in order to access the information that you're looking for, but you might be able to access what you want for free. But a lot of these you may have to pay for in order to have access, or you can also find a lot of these either in the, well, after you're in the workplace, you'll find them in the public library. They may subscribe to some of these. And so you can look there.